Welcome to part two of loan portfolio and concentration risk. In part one, in the part one video, we stopped at this slide where we were looking at the formulas for expected return and variance of a portfolio. Just a quick recap. Expected return is just a weighted average where X represents the weight of each asset. I will be the asset A, asset B, asset C. And then the returns of each, multiplied by the returns of each one of them. And then you add them together and they'll give you the return of the portfolio. I did mention that variance, which will eventually lead to calculating standard deviation. The calculating variance has a few different ways to do it. This is just representing one of them. Now, let me start saying this formula and this formula are pretty much the same. They just look different because it depends the information that you have. If you have the covariance of the formula, you would need to use this one here. If what you have is correlation and standard deviation, then you will use this one here. One thing that's important to always note is that sigma here, this symbol here, sigma, lowercase sigma, is not the same as this sigma here. And these two are not the same as these sigmas here. This is what these sigmas represent. When the sigma has a square or 2, they're in the exponent, so squared, that means we're talking about variance. That's why you see the variance of the portfolio here, which is what we're calculating. So sigma square is variance of the portfolio. Here is just representing the variance of each one of the assets in the portfolio. This sigma here, notice, does not have the square, so it's not going to be variance, but also notice has two letters, I and J in this case. It doesn't matter, it doesn't have to be I and J, it could be any two letters. But when you see sigma with two letters, it's talking about two assets. So that represents covariance. Now, down here, notice that these sigmas have only one letter. The letters are different, so they belong to different assets. And they do not have the square. So when you see a sigma with no square on it and only one letter, then that's standard deviation. So what you have here is variance here and here. This is covariance because it has two assets and not the square. And down here, no square, only one asset, that's standard deviation. This letter that looks like a P is actually a Greek letter rho, and that represents correlation. Other ways to calculate risk frontier is the Moody's Analytics risk frontier. And this is the formula they used. This is the formula for the returns. And this is the formula for the standard deviation. They have examples of this formula and how to calculate it in the textbook. Please review the examples so you get familiar on what goes in these positions. But really, they look long, but all it is notice it's AIS minus expected L, which equals also this. So depending on the information you have, you can either do this part, you get the return, or you do this part and you get the return. Standard deviation, same thing here. It just depends what information you have. If you have this information and you just multiply those two, that'll give you the standard deviation. If you have this information, then you go through this process to get the standard deviation. Also notice that this piece here in the brackets, the square root of this piece here in the brackets is a representation of variance. And then when you take the square root, it gives you the standard deviation. But since you need the standard deviation of the entire asset or portfolio, then you have to add the other piece to get that here. And once again, correlation between two items, that's the letter rho. Now here's a kind of a breakdown of total risk, and then separated between the systematic and the firm specific risk. So when they say firm risk, they're really talking about total risk of the firm, which is a combination of the systematic risk portion and the firm specific risk. When you add these two together, you get total risk. Now remember, this part can be diversified. This part cannot. Now the systematic portion of the risk in the total risk can be broken down between country risk and an industry risk. So country risk, just what it sounds like. Each country has unique situation in their economy and it has its own ups and downs. And it also has other risks associated with legal environment, corruption, etc. Industry risk, well, obviously more specific. Your health industry does not have the same set of risks that an airline does, for example. Now we take the industry risk. The industry risk itself can be broken down into industry specific risk, and then other risks that affect the different industries in different ways. So for example, global economic risk, globalization, it's a lot more of a thing now than it used to be a few decades ago. So global economic conditions may affect different industries in different ways. We could use an example of the global economic risk. If we were highly dependent of grain from Ukraine, and then Ukraine gets invaded by another country, and we don't have the same access to that supply, then industries that are dependent of grain are all affected. And that was a global economic risk. You got regional risks. That will be similar to country in a way, but a region, not necessarily a political border like a country does. So regional is more geographical. And then, of course, any industrial specific risk to the industry. And then country risk is also impacted by these things. But then there's also the country specific risk. And as you add them together, there's all the risks that are involved. So depending where you have your assets or your loans or your debt or whatever financial tools we're talking about, these items that all play a different role. Now we can consider partial applications of portfolio theory within the loan universe. We have this thing called loan volume-based models. And what it is you collect data from a large data set of loans, and then you play the averages, the probabilities of risk, et cetera, accordingly. Now, where'd you get that data? Well, there are commercial bank call reports, reports from the banks. That's one way to get them, some of them. There's data on shared national credits, a national database that breaks commercial and industrial loan volume in 2-digit SIC codes. So this is helpful when you were looking at the industry level data, and just commercial databases out there, and pay for information. They collect data, they organize it, and you pay for access to the databases. If you wanted to calculate the standard deviation within the loan volume-based models, this will be the formula you use. This is your standard, standard deviation formula. This is your typical standard deviation formula, where what you've seen here inside is variance. That's the first one you learned. You take the square root. We also have loan loss ratio based models. Pretty much it estimates the systematic loan loss risk by SIC sector. The SIC code lets you know sector and industry relative to loan loss risk of loan portfolio. So this piece here is equal to this. Now, this is a regression approach, and then you have a formula where alpha now represents the intercept on the y-axis. This beta represents the slope that you will use. So once you have these two values here, you can then input the total loan losses over the total loans, and then it estimates this right here. But also the keyword here is estimation. So it gives you an average. Now, regarding regulatory models, by the way, before we continue, all these models that we're talking about, it doesn't always mean you use one of them. You can use a combination of them in order to come up with a final number that you're comfortable with when you're trying to estimate the risk. Now, what happens here in the regulatory models is that now we enter into a more subjective way. There's not a number thing. So as this says on the slide there, credit concentration risk evaluation, largely subjective and based on examiner discretion. And here, there used to be quantitative models to say, well, when the regulations come over or the examiners come over in any legal environment, we're going to put a number to it. However, as you can see there, quantitative models were rejected by regulators because the methods were not sufficiently advanced and available data were not sufficient for estimation. So it was a bad predictor, bad estimator, I should say. The models that we had, they were not very good at estimating. An example here, dealing with life and PC insurance, property and casualty insurance. Regulators set limits on investments in securities or obligations of any single user. So what happens is, let's say a life insurance company, they collect premiums from the clients. Then they use those premiums and they invest in the stock market and equities and bonds, different investment tools. However, the regulators, I guess the laws in place, you can say, they set limits, and not just limits on amount of money, but what type of investment you can invest in. And those may be different for different companies depending on the situation. And that's what I'm trying to tell you there. And just in general, we're saying is general diversification limits. So they control the options they have to invest the money they get from the clients, and that way it protects the consumer as well. So the point here is that in that example of what happens in life insurance companies is that that may vary from company to company for different reasons. So then it's difficult to have a quantitative model, a one size fits all, because it can be very, very different. That's it for this video. See you on the next one.